So what was it that you saw? How did you position? And then what were you able to do as a result when we finally in March started to see that this was in fact going to be a serious public health crisis and a serious economic crisis, and the market started to go haywire?
Really, the first couple of weeks of March, while dramatic, were in a way what I'll call a traditional sell-off, meaning stocks went down, bonds went down, high yield bonds went down, risk assets moved lower, and they moved lower dramatically and quickly, but there wasn't a full, what I'll call seizure of the financial system or the financial plumbing until mid-March. And mid-March is really what began that period of what I'll call the global margin call, where whether it was in the REIT market, the mortgage market, the non-agency mortgage market, the investment grade bond market, the high yield bond market, there was just a total seizure of the flow of money. Ultimately, that's what then begot what sort of defines the next stage of this market experience, which was the government response. So things got so bad so quickly in the middle of March that the government, not just the US government, but around the world, but particularly in the US, stepped in with a package of responses which were as dramatic, as fast, and as unprecedented as that sell-off which precipitated it.
Does that mean that it's over? And what I mean by over is that the rally that happened and there isn't that much more runway left?
So we have this conversation a lot with our constituents. I say, if the question is, did I miss it? The answer, you need to first break that into two parts. If the question is, did we miss, or did one miss? We were thankfully in a position to take pretty good advantage, but did one miss buying the bottom of the greatest margin call in history? Our answer to that is yes. That margin call, and I'm calling it a margin call, it was only in part a margin call, but it was this total lack of balance sheet or capital in the world for a very brief period of time. The opportunity to buy the bottom of that, whether that was in a high yield bond, a non-agency mortgage security, a stock, or anything else, that is gone. It may come back. I don't necessarily think it will. I think the amount of government support in the system in so many different ways is likely to take that type of margin call off the table for at least this episode. Never's a long time, so many more things will happen till the end of time. But in this episode, did one miss the margin call? Yes. Now, the economy is in a very troubled place. Frankly, the world's in a very troubled place. The market is across all asset classes. The markets are incredibly volatile. The performance within asset classes is incredibly dispersed. There will be a likely tremendous number of defaults, corporate and otherwise. And so if the question is, has the opportunity to generate good returns by taking an opportunistic approach across all asset classes around the world, the answer to that is no. That has not been missed. I think that's going to be with us as the global economy is likely to move in these fits and starts as we all figure out how to most safely and responsibly respond to the virus.
There are a lot of people out there who missed the great reflation in U.S. equities over the past, call it 3 months, Jimmy. Yet you say there are lots of other opportunities for people to take advantage of over, say, the next year, 18 months. What are those things? What are those opportunities? Where is money going to be made?
Mm-hmm. So I think we can start with what we'll call spread asset classes versus equities, and we'll talk about equities second. Spread asset classes, that's corporate credit, loans and bonds. It's structured credit, which means mortgages and CLOs and things like that. It means convertible bond arbitrage, all these different areas where investors are effectively receiving some form of spread or carry or return in exchange for holding some type of risk. And what I'm constantly saying internally and externally is, for all spread asset classes, the most simple, the most exotic, those spreads are materially tighter than they were on March 23rd and materially wider than they were on January 1st. So if you think about historically, these are great areas to try to generate a good return in. They're less efficient markets. They can be opaque. They can be less liquid. They can be more technical or process driven, if it tends to historically be a great place to make a return, well, today we're at historically wide levels, oftentimes multiples of the typical level of spread or return one gets in these asset classes. So yeah, if you compare it to the bottom of the margin call, it's going to look quite expensive. If you compare it to decades and decades of historical levels, the opportunity set in whether that's convertible bond arbitrage, high yield bonds, non-agency mortgages, these asset classes are offering more return than they do 90% of the time historically.